This is really a historic moment. This is the first bear market that we've seen in the S&P 500 since March of 2020. But in terms of the definition of a bear market, this is the most traditionally accepted definition, down 20% from the last peak. You could also take a look at it, though, from a sector standpoint. Many analysts take a look at it that way. And on the year right now, the majority of the sectors are now down 10% or more. So there are some analysts who would say we've been in a bear market for the S&P 500. Or you were talking about how one of our colleagues, John Authers, was talking about it from a valuation perspective. Right. The NASDAQ has been in a bear market for many weeks. The Russell 2000 has been in a bear market for quite some time. So it's almost like the S&P 500 is catching up with some of the bearishness, the price action that we've seen in other markets.
The question I always have is, and then what? I mean, what does that say? Does that say something about a possibility of recession? Does it say something about bottoming out? Does it say something about when it starts to come back?
Well, if we take a look at the last couple of bear markets, there was the one in 2020 that was very brief, although very deep. If you go back to 2008, that was obviously a horrible one. The S&P 500 down 50% in a very short period of time. However, if you go back to 2000 to 2003, and this market action reminds me of a blend of those two time periods. 2000 to 2003, it was really a rolling bear market where stocks would go down about 20%. They would come back up 10 to 15%, go down 20%, and so on and so forth. Some of that, interestingly, David, as we've been talking about this week, had to do with the then big tech companies, including Cisco and EMC. These companies, they just could not provide guidance that was reliable because the corporate IT spending outlook continued to decline. So they would lower guidance, but they would have to do it the following quarter. Are we in a time period now where that's happening, but the bogey is not the corporate IT outlook, it's inflation? If inflation is unmanageable, as we know right now for some of the big retailers, if that proves to be the case going forward for another quarter, it could really be an issue. You could continue to see the floor drop on the profit outlook.
Is this a delayed reaction to the run-up in the 10-year yield? Because the 10-year yield really jumped up, and now it's actually coming back down again. You'd think that with the 10-year yield coming back down, it might help the stocks, not hurt them.
Yeah, that's a great point. It's interesting. The 10-year yield in terms of that run-up to 320, that was probably pretty overdone, and I think that that's the understatement maybe of the year. It would have been much more reasonable for the 10-year yield to, I don't know what level to have stayed below, but 2.5% in terms of expectations around the Fed. But it overshot so much to the upside. It's now coming in. And then on top of it, when you have a stock sell-off like this, remember Haven Bonds, there's a bid for bonds as well. So that's something that's bringing it back in. But if you remember the first time that the 10-year yield went from about 50 bips to above 150, and it went to 175, and then it quickly came back down toward 110, and there were a lot of folks saying it was going to go below 1%. So we're just seeing these huge swings based on the uncertainty.
Yeah, the other question, just to leave it with you here, Abigail, is whether this is interest rates or whether it's something more fundamental in the economy. Because we did have those results from the likes of Walmart and Target this week that I think made some people nervous.
Yeah, well, in terms of the economy, we have to remember the GDP, about 2/3 of it is the consumer. There are mixed signals on the consumer, but overall, I would say based on this week and what we know right now, the consumer is probably okay. U.S. retail sales in the month of April, they were stronger than expected. A lot of these companies, even though they couldn't manage rising costs, they beat on sales, so there was consumer demand. Yes, there was more reliance for lower end and store brands, but then you have some of the nice to haves like your Canada Gooses and your Uggs, Deckers, Foot Locker. These companies are really doing okay relative to sales. Plus, if this was an earnings week for the airlines, it might be a very different conversation. Because remember, United Airlines earlier this week pre-announced the upside, saying that they think demand is going to be huge. So maybe that's where a lot of the money is going to, and a lot of people have been looking for that, for it to come out of goods and go into services. So we have more information to be seen.